really tight time frame this morning. And Rich, if you could do a roll call for us.
Yes, good morning. Chairman Representative Kelly, present in person. Vice Chair Representative Hoheisel, present in person. Ranking Minority Member Representative Hsu is in person present. Representative Anderson is present remote. Representative Baker, not seen yet, but I'll keep checking. Representative Bergkamp is present in person. Representative Day is present in person. Representative Donahoe is present remote. Representative Finney is present, she's remote. Representative Kessler is in person, present. Representative Lynn is present in person. Representative Neely is present and remote. Representative Poskin is present remote. Representative Samsill. Representative Topliker. Representative Wassinger is present in person. Representative Weigel. I'll continue to check the monitor, Mr. Chairman, for any late arrivals.
Okay, thank you, Rich, very much. Well, today we have a hearing on House Bill 2189, and David, if you're out there in video land, if you would please give us a kind of a review of this bill.
Yes, thank you, Mr. Chairman. Good morning. House Bill 2189 would make several amendments to provisions of the Uniform Consumer Credit Code that relate to consumer loans, and they'll also be known as alternative small installment loans. You might have heard of these, described as payday loans or vehicle title loans, but under the bill, they'll be known more as consumer loans or alternative small installment loans. Kind of just highlighting some of the major provisions governing these installment loans. They would be capped under the bill. The interest on the loans would be capped at 36% per annum. Monthly maintenance fees on such loans would be capped to the lesser of 8% of the loan amount, or $30. If a loan is for $400 or more and the loan term is for 4 months or longer, there can be an underwriting fee not to exceed $25 added to the loan. The bill also says that the minimum term of any loan shall be 3 calendar months, except in cases where the total monthly payment on the loan does not exceed 5% of the borrower's verified gross monthly income or 6% of the borrower's net income. It can be a shorter term. The lender is required to make a reasonable attempt to verify the borrower's income by obtaining 1 or more recent pay stubs or some other evidence of the borrower's income. The total amount of fees and charges for such loans would be limited to either 60% of the originally contracted loan amount if the loan amount was $1,500 or less, or it could be 75% of the loan amount if the loan amount was for more than $1,500. A lender is limited to making 1 loan to the same borrower at any time, so only 1 loan per borrower. A copy of the loan contract shall be provided to the borrower, and the contract shall contain disclosures relating to the total amount of fees and charges regarding the loan, the payment date, total number of payments, the annual percentage rate inclusive of all fees, all disclosures required under the Truth in Lending Act, the right to rescind the loan within 3 business days, and the right to revoke authorization for electronic payments. If the loan is prepaid in full or refinanced prior to the loan's maturity date, the lender is required to refund to the borrower a portion of the interest charges for the actual time remaining for the period following prepayment, a portion of the monthly maintenance fees, and a portion of that underwriting fee. Lenders are prohibited from accepting real or personal property or any interest in any property in connection with the loan other than a check, or in those particular cases where it's a motor vehicle title loan, the title to the motor vehicle. A lender shall not draft funds electronically from a borrower's account without the express written authorization from the borrower, and shall stop attempts to draft funds electronically upon request of the borrower. A lender may take a security interest in the title of 1 or more motor vehicles in the title of 1 motor vehicle that the borrower owns prior to the loan transaction, except that if the vehicle's title evidences that the vehicle is encumbered by a prior lien, then they can't take that as a security interest. The lender shall promptly release the security interest when the borrower's obligations on the loan are satisfied in full, and shall take any necessary action to reflect termination of the security interest on the face of the vehicle's title. The borrowers shall be permitted to recover promptly and at no cost personal items from a repossessed vehicle. The lender shall not charge any collection costs, attorney fees, or any other fees except when the lender becomes entitled to seek a personal money judgment against the borrower. And then lender is entitled to seek such personal money judgment for amounts in the loan if the borrower intentionally damages or destroys a vehicle, intentionally conceals the vehicle, gives the lender a lien on a vehicle already encumbered by an undisclosed prior lien, or subsequently gives a security interest to a third party without the lender's written consent. In addition to the other requirements for consumer loan contracts that were listed above, those required disclosures, a loan contract involving a vehicle title shall also include the make, model year, and vehicle identification number of the vehicle in which the security interest is being given, and the fair market value of the vehicle, and a statement printed above the borrower's signature detailing the rights under these types of loans. Any person who enters into a consumer loan transaction under the section shall file a report with the administrator of the UCCC, which is defined as the Deputy Commissioner of the Consumer and Mortgage Lending Division of the Bank Commissioner's Office each year, and that administrator shall publish at least annually a list of information regarding all such loans and make that list available to members of the public. The bill does have a delayed effective date. It would become effective January 1, 2022. And I know there's a lot in this bill. I kind of went through the main portions, so if there are any questions about the details and the language, I can stand for them now.
Thank you, David. And any questions for David? Representative Hsu?
Thank you, Mr. Chair. David, maybe this was intended, or maybe I'm reading it wrong, but on point 10 there, should it say without express written authorization, or is a with correct there?
You're correct, Representative Hsu. That's just a typo. It is without express written authorization. So yeah, the borrower has to give written authorization before there can be any electronic funding. So yeah, that's just a goof on my part. Sorry.
Thank you.
Representative Hoheisel?
Thank you, Mr. Chair. Thank you, David, for that breakdown. I have two quick questions, if I may. First, this caps it at not one loan at any one time from an institution to a borrower. Do we currently have any caps on that?
Under current law, it is no more than two loans outstanding at any one particular time. So from 2 to 1 would be the change.
Okay, and my second question is, if this passes, this would only apply to those doing business in the state of Kansas in regards to those who operate on Indian tribal, Native American tribal reservations. Would this cover those as well, or would this only cover those operating in the state of Kansas that are not on Native American tribal reservations?
Yeah, I'm not entirely sure about how the tribal stuff works, but I believe it would only be to those not on tribal reservation ground, and be those in the state of Kansas regulated under the UCCC by the State Bank Commissioner.
Thank you, David. Thank you, Mr. Chair.
Thank you, David, very much. And in order to keep on schedule, and the goal is to give each group an equal period of time and still have about 15 minutes left for questions at the end. We'll go to Melissa Rennick of her research to kind of give us a little background. And you have something from Melissa in your file that you can refer to, and also in your file of papers on this, you do have a physical note that please refer to. So Melissa, if you could kind of give us a little breakdown on the Payday Lending and others, you're the expert in that area, and if we can kind of go through that fairly expediently, then we'll have plenty of time for everyone else. Thanks, Melissa.
Thank you, Mr. Chairman and committee members. Good morning. KLRD has provided information regarding the consumer credit transactions that are subject to the UCCC, or the code as it's often referred to. Also highlighted is a brief review of regulatory oversight that David referenced, and review of the current permissible interest rates that are established under the code. And those include close-end or installment rates, which David highlighted as considered in House Bill 2189, open-end or revolving credit rates, and then lender rates. A brief history of legislative review and relevant prior legislation is also included. And in addition, we were asked to provide information regarding states' regulation of small dollar lending and recent law enacting a rate cap similar to what is proposed in House Bill 2189. That information begins on page 4 of the memo KLRD has provided and continues into the memo's appendix. A brief consideration of consumer loans and small dollar lending at the federal level is also provided. And then additional comment I would note on the consideration of small dollar lending was previously provided to you in an article from the legislator briefing book, and that is linked as well in this memo, and that was specific to the topic of payday lending. States highlighted in the memo include very recent activity occurring in the state of Illinois, Nebraska, which passed a successful ballot initiative last November, South Dakota, and Colorado. These were all states, excepting Illinois, that implemented the rate cap, the 36% rate cap, using a ballot initiative. Illinois was law. And in addition to Illinois, New Hampshire and Montana also enacted such caps in law. And I would note there's just an oversight in the memo. The state of Virginia also has enacted relevant law in 2 separate pieces of legislation in January and April of 2020, and those provisions became effective very recently, January 1st of 2021. We'll update the memo to include the law and submit that for the record. In addition, the state of Ohio has a Fairness in Lending Act enacted in 2019. While not a 36% rate cap, a separate rate cap and other changes to consumer loan provisions are highlighted in the memo. And then for reference, we also included Kansas and other surrounding state data for the committee's review. And Mr. Chairman, I wanted to keep that brief, so I'm happy to answer questions now or at an appropriate time.
Melissa, Representative Hoheisel.
Thank you, Mr. Chair. Thank you, Melissa, for that. I have one quick request from research, if I may. And at your nearest convenience, could you give me a breakdown of the states that instituted the 36%? How many payday loan lenders were in those states before, and how many were in those states after? If you could give me that breakdown, just email it to me whenever you get the opportunity.
Sure, and I will comment, there are some reports that have been issued. I'm aware of one in New Hampshire. So, and a conferee coming up from Pew has previously presented some information on the topic, but I will see what we can find from each of those states.
So thank you, Melissa. Thank you, Mr. Chair.
Thank you. Any other questions for Melissa? Representative Finney? Representative Finney, you're muted, I think. We can't hear you anyway. Could you message Representative Hsu and we'll get your question? Let's see if we have. Representative Finney, try again and see. There was an adjustment made to the volume.
Can you hear me now?
Yes.
My question for Melissa is, about 5 or 6 years ago, there was a bill passed in the House that limited the amount of
The question, I believe I'll repeat it for Melissa, was that Representative Finney said that 5 or more years ago, there was a law passed, she believes, that limited interest charges to military families. I know there's some federal regulation on that, but as far as a Kansas law, any comment on that, Melissa, from your memory? Better than mine, for sure.
Yes, Mr. Chairman, there is law that governs military bases, and the 36% rate cap is applicable there. Kansas did consider and enact law. It was actually 2005, and that was Senate sub for House Bill 2172. In addition to some changes that were made to the UCCC and finance charges, there were protections added for military borrowers, and this is what she is likely referencing. Those included that lenders could not garnish wages or salary for service in the armed forces. They had to defer collection activity for borrowers who might be deployed for combat support for the duration of that post. They could not contact anyone in the military chain of command of the borrower in attempt to make a collection. They had to honor all terms of the repayment agreement, and they could not make a loan to a military borrower whenever the base commander has declared that person's place of business off limits to military personnel. So these were a series of borrower protections that were given to military service members in the 2005 legislation.
Thank you. Does that answer your question, Representative Finney? Looks like you said yes. So we will thank you. Any other quick questions? We want to move on here? No? Thank you, Melissa. And we're going to do just a little differently this morning, but we're going to officially open the hearing on House Bill 2189, and we're going to start with Mike Eisenbrenner of the Office of the State Banking Commissioner, and he is classified as neutral, which I guess all good regulators would be classified as neutral, and let him start out, and then we'll go to our proponents and then to the opponents, and we're running right about on time. So thank you, Mike. Welcome.
Thank you, Mr. Chairman, members of the committee. My name is Mike Eisenbrenner. I'm the Deputy Commissioner of the Office of the State Bank Commissioner, Consumer and Mortgage Lending Division. I'm also the Administrator of the UCCC. I want to introduce a few folks I have with me today. I have Melissa Wangman, she's our General Counsel. I have Matt Shoger, he's our Staff Attorney, he's in the other room. And Jim Payne, he's our Director of Examinations, he's in the other room also. I'm going to talk a little bit about our office and how our office licenses and regulates payday lending, talk a little bit about payday lending itself. The role of our office, the Consumer and Mortgage Lending Division of our office, is to license non-depository entities that conduct mortgage business, extend consumer credit, provide debt management services, and oversee money transmitters. The CML division is fully funded through licensing and application fees and volume fees. We also examined entities licensed for compliance with state and federal law. We administer grants, and we respond to consumer complaints and concerns. One of the main laws that we enforce is the Kansas UCCC. It's the primary state law that governs consumer loans and consumer credit sales. And as stated in the UCCC, it's for any loan for personal, family, or household use. This coverage includes payday lending, title lending, installment loans, auto loans, open-end lines of credit, consumer credit sales, such as furniture and jewelry. The UCCC defines how credit transactions may be structured, specifies what information must be provided to consumers, and sets limitations on fees and interest. Payday loans under the UCCC are governed under the UCCC. Payday lenders must get a license with our office to offer payday lending. And the two sections in the UCCC that govern payday loans are 16A-2-404 and 16A-2-405. Terms of payday loans: a payday loan cannot exceed $500. The term of the loan must be between 7 and 30 days. and the repayment is anticipated to be a single payment. The fees on payday loans the finance charge cannot exceed 15% of the amount borrowed, which is $15 for every $100 borrowed. The lender may assess and collect no more than 3% per month of the loan proceeds after the maturity date, and a $10 charge is permitted for an insufficient check fee, or if they contract for it, they can get a $30 charge for an insufficient check fee. There is no Kansas law that requires a repayment plan on payday loans, but there also isn't one that prohibits a repayment plan. If a repayment plan is offered, it must conform to the UCCC and may be an amendment to the original contract, not a new transaction, and no additional fees may be charged. There's a few disclosures that are required for payday loan contracts. One is the notice to consumer. This basically says that you don't sign it before you read it. You can get a copy and you can prepay at any time without penalty. There's also a notice to borrower, which tells the consumer that Kansas law prohibits the lender and the related interests from having more than 2 loans outstanding to them at any one time. And that notice to borrower must be disclosed in both English and Spanish. Several prohibitions on payday loans. A lender or related interests cannot have more than 2 loans to the same borrower at any one time. A borrower cannot obtain a new loan from the same lender or related interest to pay off an existing loan. A lender cannot make more than 3 loans to the same borrower in a 30-day period. And no insurance charges or other charges are permitted with payday loans. Payday lenders cannot sell any other products in connection with making the loans, and the lenders are not allowed to use or threaten criminal prosecution in any way. Sorry. Sure. There's certain requirements for payday lenders. Oh, there we go. Each lender must keep a journal of loan transactions for each borrower containing the borrower's name, address, phone number, and the date of the loan. All lenders must keep their records for 36 months, and they must submit an annual report to our office regarding the dollar amount and loan volume for each calendar year. I have a whole slide here on military borrowers, but Melissa already covered that, so I won't go through that again. Our agency's authority is to conduct examinations, and we try to do that every 36 months. We will do it more frequently if we have a reason to, if we get consumer complaints or something. We review transactions for compliance with state and federal law, as well as review the management, company policies, and procedures. We have the statutory authority to take a range of enforcement actions needed to keep companies in compliance. Those enforcement actions include consumer restitution, fines, and/or license revocation. We have seen a few trends in small dollar lending in the last few years. The main one is a decline in traditional payday lending. But as those have declined, there's been an increase in open-end lines of credit. Right now in Kansas, we have 53 companies that offer either payday lending or title lending. They have 217 branches for a total of 270 locations in Kansas. We do get consumer complaints from time to time regarding these high-cost loans. We have a consumer affairs department in our office that researches the company, determine their licensing status. They obtain relevant documents and review for violations, and then they communicate with the consumer and the company to resolve the complaint. In 2020, we had 26 small dollar loan complaints. And in the last 5 years, we had a total of 134 complaints on small dollar lending. If we do find a company's not complying with the law and we issue fines, we have a consumer education settlement fund that money goes into. In the last 20 years, we have provided $5 million in grants from that fund, which is about $250,000 a year. And I have several just charts and stuff that's in the packet, talking about the largest payday lenders in Kansas, largest title loan companies, the largest other high-rate loan companies. I'll talk just a second about the bill being discussed today, House Bill 2189. The Office of the State Bank Commissioner is neutral on this bill. We have reviewed it, and we do not see any issues with being able to regulate it. I think we could issue licenses and regulate if we needed to. We have heard other options being discussed, other alternative products, longer-term products at a fixed 36% interest rate, and we also think that approach would work. And I have my contact information here, and I can stand for questions.
We're going to hold questions to the end so that we make sure. So if Representative Lynn, just if you could jot your question down, and we'll have time at the end to answer that. This is all of our neutral testimony and from the Bank Commissioner's office. So this will close the neutral portion of the hearing, and we will open the proponent portion of the hearing. And we're going to have three presenters, and we're running just about on time, and it looks like each group, in order to leave time for questions, will have about 20 minutes, something like that, total. And then we want to leave at least 15 minutes at the end for questions, just in case a number pop up during the presentation. But we would like to, after officially closing the neutral portion, I'd like to open the proponent portion of our hearing on House Bill 2189. And the first proponent that I have listed to speak is Nick Bork, Director, Consumer Finance, the Pew Charitable Trust, and he will be coming to us remotely. So, Nick, please welcome to the committee, and we're looking forward to hearing your presentation.
Thank you, Mr. Chairman and members of the committee. Are you able to hear me?
Yes.
Great. My name is Nick Bork. I'm Director of Consumer Finance at the Pew Charitable Trust, a large nonprofit research and public policy organization. I lead a team of skilled researchers and analysts who have studied the consumer credit markets for over 10 years, and I myself have over 20 years of experience in this field, including in market research, product management, and legal advising. I thank you for the opportunity to speak today. Pew's analysis confirms that HB 2189 uses an evidence-based approach to modernize state law. It will benefit Kansas by stopping well-documented consumer harms, saving residents money, and also enabling competition that expands small dollar credit options throughout the states. For these reasons, Pew supports HB 2189. I will summarize a few points from our 23-page written testimony. First, the Kansas small dollar loan market is uncompetitive and overpriced. Many of you have heard over the years about problems in Kansas's consumer loan market. I'm going to shorthand it for time. Payday loans, under the way the statute is written, they must only last 30 days or less. They must have a single balloon payment. That is unaffordable for borrowers, and it leads to consecutive repeat borrowing because of that unaffordable payment. APRs under that statute are 91%, which is the typical APR on a short-term consumer loan in this country. Unlimited credit, KSA 16A2-401 allows unlimited rates. The statute is intended for credit card-like loans, but a handful of payday and title loan companies have taken advantage of this to start offering lines of credit with APRs of 299% and higher. Only 4 other states operate this way. And particularly unusual in Kansas is vehicle title lending, where title loans are only available in credit in Kansas as open-end credit. Kansas is the only state in the country like this. According to recent OSBC data, 8.7% of title loans ended in repossession in Kansas. That's 1 in 12 loans. And 95% of repossessions end in the sale of a Kansas car at auction. The market in Kansas is highly concentrated, as you can see from the bullet points on page 2 of our written testimony. According to OSBC data, 4 companies control over 68% of the payday loan market, and just 1 company controls more than half of the title loan market in Kansas. As a result, The small dollar loan market in Kansas is dominated by a handful of companies that charge more than is necessary to make credit available. Most of them charge their customers in other states. This is harming Kansans, and the only reason for it is that Kansas law is written this way, including it prevents lower cost lenders from competing by offering lower cost closed-end installment loans. This brings us to HB 2189, which is designed to respond to these problems. HB 2189 would enact interconnected reforms that address these problems comprehensively. Now, you've heard a summary of what 2189 does, and page 3 of our written testimony includes a summary as well. Here are some key highlights. It raises allowable interest rates on closed-end installment loans up to 36%. It applies the same rate cap to the open-end credit code and caps fees to prevent evasion. And it revises KSA 16A2-404, the payday loan section, in order to create a new type of alternative installment loan. Now, this includes removing that 30-day maximum loan term and letting loans go as long as 24 months so that consumers can have affordable installment payments. It includes raising the existing $500 loan limit to $2,500 so that Kansans can get the credit that they want and lenders can make more revenue offering larger loans. It does have a 36% interest rate cap, but it also adds a monthly fee of up to $30 and other fees, and that is the difference that allows credit to flow under this model compared to a hard 36% rate cap. Now, an observation about this pricing. APRs on these new alternative installment loans will not be cheap. 36% plus the allowable fee will result in APRs of between 36 and 196%. It's not cheap. Still, these new loans will cost hundreds of dollars less than what borrowers pay in Kansas today, with safer and more affordable terms. Now, pages 4 to 6 of our written testimony show that HB 2189 builds on extensive evidence. This will not eliminate high rate credit, as I've just demonstrated. Compare that to states you heard about earlier, Nebraska, South Dakota, Montana, and about 15 other states with hard 36% rate caps and no extra allowable fees. In Nebraska, where 83% of voters just approved that ballot initiative of a hard 36% rate cap, there are now no more payday loan stores. That policy eliminates payday loan stores. Instead, HB 2189 sets a middle ground approach. It's pro-credit, allowing lenders to charge that 36% interest plus the monthly fee up to $30 and other fees. Those added fees are what lets credit flow. HB 2189 is similar to laws that were enacted in Ohio and Colorado in 2010 before they passed their ballot initiative, and in Virginia recently, where credit continues to be widely available. There are over 120 payday loan stores in Ohio today in response to the earlier question. That's 120 payday installment loan stores. In addition, there are many other mainstream installment loan stores in Ohio. This bill is even more pro-credit than those states, though, because it allows larger loan sizes and higher fees. It also allows the taking of car titles to secure loans, which Ohio explicitly banned, for example, which is why title lenders closed in that state. You can see details about these comparisons in Appendix 3 of our written testimony at page 21. I'd also encourage you to look at Appendix 4 of our testimony at page 22, where you can see examples of what loans would be allowable under HB 2189. I think you'll readily see that HB 2189, especially in that new alternative installment loan section, would allow sufficient revenue to sustain credit availability. And indeed, credit continued to flow after similar reforms in other states. These comparisons to other states are important because, as a matter of fact, the largest payday lender in Kansas is also one of the largest lenders today in Ohio and in Colorado. Even though Colorado capped by ballot initiative their law in 2018, still operates under another statute there that's similar. At least 4 of Kansas's largest payday lenders operate today in Ohio, and at least 6 of Kansas's lenders operate today in Colorado. This includes Curio, which is opposing this bill today. They operate as Speedy Cash in both Ohio and Colorado, and again, in Appendix 4 of our written testimony, you can see examples of the loans they offer in different states. Now, I don't have time to walk you through, I'm sorry, I misspoke. It's Appendix 1, where you can see examples of the loans that these companies offer in other states and in Kansas. I don't have time to walk through these examples in Appendix 1, but I can tell you that if you look, you'll see there's a company charging $313.43 in Ohio, but $853.11 in Kansas. There's another company charging $95 in Colorado and $139.55 in Ohio, but $743.17 in Kansas. Another company charging $260 in Colorado, $408.85 in Ohio, but $1,242.45 in Kansas. The reason? That's the way Kansas law is written. Pages 7 and 9 of my testimony establish the following points in favor of 2189. We understand that at least 5 consumer loan companies support HB 2189. It's not hard to see why. 2189 would increase allowable interest rates on mainstream closed-end installment loans and creates that new alternative installment loan that I just described for up to $2,500. Consumer, faith, and community lenders support HB 2189, and it's not hard to see why. The bill would enact much-needed modernization of Kansas laws, substantially reduce what Kansans pay for credit, keep credit widely available, and protect families from practices that harm them today. The bill also incorporates extensive input from OSBC, as you heard. Now, payday and title lenders oppose this bill, but HB 2189 fairly addresses their concerns. Now, it's not hard to see why they oppose this bill. HB 2189 would subject them to competition for the first time and allow Kansans to save a lot of money. That is, per borrower revenue will drop. But HB 2189 addresses reasonable concerns from payday and title loan companies that they've expressed in prior testimony in Kansas and in elsewhere. You may recall that in 2017, there was that looked a lot like 2189, but 2189 is much more generous to lenders than that prior 2017 bill in Kansas, in part because of the testimony that they provided. 2189 allows much larger loan sizes, $2,500, not just $500, and also much more revenue, and addresses many other concerns. You can see them outlined, some of them outlined on pages 8 to 9 of our written testimony. My final point, HB 2189 is compatible with proposed federal regulations, and you can see how in our written testimony. In conclusion, this careful approach to finding the balance between the interest of lenders, consumers, and competition explains why, for the first time in Kansas, at least 5 consumer loan companies and the Kansas Financial Services Association have joined community and faith groups to support this year's bill. Pew also supports HB 2189 for the reasons I've expressed. Thank you for your time, and I'd be happy to take questions.
Nick, and we'll have questions at the end of all presentations. And we have now, by the way, I figure probably about 5 minutes each for our last 2. We'll see how our next one goes. Our second proponent is Chuck Weber, Executive Director, Kansas Catholic Conference. Welcome, Chuck. This is something that you've set on both sides on this before, so I'd like to welcome you back.
Thank you, Mr. Chairman. It's good to see you. Good to be here with you. Up early, making your $88.66 today. So the people of Kansas are most appreciative, as am I, for you to have this hearing. My name is Chuck Weber. I'm the Executive Director of the Kansas Catholic Conference. It's the public policy arm of the Catholic Bishops of Kansas. This is an issue that we have had a deep interest in since before my time, actually, in a number of years. I'm joined virtually by Jeanette Pryor, my public policy specialist, who's done a lot of legwork on this, which I very much appreciate. To your legislators, this might be a topic that you walk in and you've got sort of a default button. This is how I'm going to vote. This is how I feel about it. But it seems to me that as you dig into this issue, And Mr. Bork gave you a lot of nuts and bolts there. But as you dig, the further you dig into it, you'll find new facts and new perspectives worthy of your consideration. And you might actually have more of an open mind maybe than you might originally have thought. I know this was the case when I was a legislator. This is one of the, I must admit, one of the few issues that I changed my mind on prior to what I'm doing now and when I was in the legislature. So you might, as you dig into it, maybe there is a role for government here. Maybe there is something happening out there for our people that needs to be changed. This issue has been around a long time. It's been in this building a long time. I want to direct your attention to the third page of my testimony. I have a color copy, but this is the cover sheet from 1935. This is a document that we surfaced from the library in the building here, and it's called The Loan Shark Problem in Kansas. And it's prepared for the Committee on Small Loan Interest Rates of the Kansas Legislative Council, prepared by the Research Department of the Kansas Legislative Council. So I know Melissa has some items for you, but maybe this was the KLRD of 1935. But clearly, it seems to me, if you use your imagination just a little bit, 86 years ago, legislators like yourselves were sitting here wondering, there's something going on out there that maybe we need to address. And how can we make life better for the people we represent, but balancing that justice of policy against the rights of lenders and their ability to conduct business. So we actually have a link to that 1935 report. I'd encourage you, it's fascinating. We don't use the loan shark language today, but it's fascinating that how things change, they remain the same. And the one thing I want to point out to you is that back then and even today, when people take out a short-term loan, a payday loan, they're doing so under duress. They're under, you know, their financial advisor is not telling them to go to payday loan to take out a loan. You know, if they listen to Dave Ramsey on the radio, if that's their financial advisor, they're not saying go to payday loan when you get in a pinch. And so in virtually every transaction, there is at least a goodly amount of pressure on the consumer. And this is what I would say bothers the Catholic Church in our way of thinking. This doesn't seem like justice, like fairness. So it's this inherent pressure that's noted in Catholic Church teaching going back centuries. It's, as I mentioned, the unfair part of it. So 86 years ago, legislators were looking for solutions. You have a solution in front of you today, and you have a chance, unlike your predecessors of decades ago, to move the needle on this. And so I would ask for your support on HB 2189, and I thank you for your time, and will be here in the other room, I guess, or I'll stand here waiting for your questions as they come. Thank you, Mr. Chair.
Thank you, Chuck, very much. And our third proponent is Brandon Mays, President, Chief Financial Officer, Atlas Credit Company, Tyler, Texas. And Chuck, you did a great job sticking to that 5-minute range. So Brandon, if you hit that, we're going well. Welcome to the committee.
Thank you, Chairman Kelly. Thank you to the other members of the committee as well. My name is Brandon Mays. Like you said, I'm the President and Chief Financial Officer of Atlas Credit Company. We are a traditional installment lender based in Tyler, Texas. We operate in multiple states with multiple brick and mortar locations centered around those states. Our company has been in business since 1968, so well over 50 years. During that time, we've served 2.5 million customers, lending over $3 billion worth of loans to those consumers. So we're not in any stance new to the game when it comes to installment lending. Specifically, the other proponents have told you, ins and outs of the bill. I'm here to illustrate and to show the committee that from a business stance, this is very doable and it's profitable for businesses. During our time we've set ourselves apart that we don't participate in markets that are unfavorable to consumers. Our philosophy as a company is that there needs to be a mutually beneficial relationship between ourselves and the consumer. And like I said, we just don't participate in markets that don't are not conducive to that philosophy. We participated in the push that got the Virginia legislation passed last January. We honored our promise, and we now have 10 locations currently under licensing review in that state. We would do much the same thing in the state of Kansas to serve the Kansas communities if HB 2189 was enacted in Kansas. To try to illustrate a few of our differences between ourselves and Payday, our installment loans are reported to all 3 credit bureaus. Payday loans they are prohibited from reporting to any of the bureaus, at least the main 3. We do ability to repay checks. So essentially we budget consumers to make sure they have the available income to pay back the loans. Payday loans do not do that. Obviously, installment lending is inherently very different as far as repayment. So ours are very structured. There's an equal installment payment every month. There's no balloon payments. There's nothing like that. We give the consumer a clear line out of debt. So our average, lowest we lend is $100. The highest we lend is $2,500. That cap varies from state to state that we participate in. Our average is about $1,000. It's about a 12-month loan. That's very clear cut. They make 12 payments. They're out of debt. We pride ourselves on, great customer service. Obviously, we abide by all laws, both state and federal. With that compliance comes great customer service because you can't have one without the other in the markets we participate in. I can't offer installment loans to Kansans under current law in the state of Kansas. I just can't do it. Obviously, the max repayment term, as you heard, was 30 days. That's just not conducive to installment loans. HB 2189 would readily give us access to participate in the state. We would initially, bring a large, sizable initial capital investment to the state to open branches, to hire employees, to serve the local, Kansas residents. Again, HB 2189 would immediately allow us to do that, and we would immediately begin groundwork and laying the foundation to do that at the enaction in 2022. Again, we are vast proponents of this. Our financial status shows that this is very profitable for companies to come in and participate in. With that, I yield the floor back. We're proponents of HB 2189. I open myself up to questions at the end.
Very much, Mr. Mays, and you too were right on time, so appreciate that. Committee, that is our oral proponents. I'll draw your attention to in your packet, we have written proponent testimony from Andrew Morrison of Burnage Management Sun Loan Company, Tom Hong, CEO Possible Loans, Emily, a bunch of names that are hard to pronounce in here. Emily Fetch, Director of Financial Policy, Kansas Action for Children. Rachel Taylor, District Manager, One Main Financial. Elizabeth Carson, Carson Law, LLC. Rabbi Reiber, Executive Director, Kansas Interfaith Action. John Shively, Director of Office of Justice, Peace and Integrity, Sisters of Charity at Leavenworth, and Chris McKinley, Landmark Financial Services. So if you would read through those and take that in mind for our future action. This will close our proponent portion of our hearing, and we will move now to our opponent portion of the hearing on House Bill 2189. And the first opponent that I have listed is Melissa Soper, and Senior Vice President of Public Affairs, Curio Financial Technologies Corporation. And welcome to the committee, Melissa.
Terrific. Chairman Kelly, members of the committee, can you hear me okay?
Yes.
Great, thank you. Thank you for the opportunity to submit written comments and address the committee today. So I'm Melissa Soper with Curio Financial Technologies Corp. We do business in Kansas under Speedy Cash, and we operate both in-store and online across 34 states. We were actually founded by 3 high school friends from Wichita more than 23 years ago, and we continue to be headquartered in Wichita, Kansas today, where we employ 825 team members. In Kansas, we operate both online under speedycash.com and through 10 retail Speedy Cash storefronts. We offer 3 different lending products: the single repayment payday loan product, the line of credit product, and also an auto title loan product. Our proprietary technology enables our customers to manage their loans with us seamlessly across all our channels. So our stores, online, via our mobile app, or by calling the call center. While we offer 3 credit products in Kansas, a majority of our customers choose our unsecured line of credit product because it provides the most flexibility for them. Customers who qualify are approved for a specific credit limit. And much like a credit card, the customers may then draw funds that they need and pay interest on only what they have drawn. Customers have the option to make the minimum payment, which includes the interest due and a percentage of the principal, or pay off the entire amount due. The cost of credit is simple. We charge interest of just under 1% per day on the outstanding principal. There are no upfront fees, no loan origination fees, no monthly maintenance fees, no credit insurance, no ancillary products, no other fees. If a customer needs to extend a repayment date for any reason, they can simply call our store or call our call center, and we will extend their payment due date at no additional fee as well. We never charge late fees, and it's our goal to work with our customers on alternative payment schedules to help them keep in good standing. Non-prime consumers in Kansas are fortunate to have a broad range of state licensed lenders and credit products available to them. While the current statutory framework allows for a myriad of choices for consumers across the entire credit spectrum, particularly subprime and near prime borrowers, the regulations do have a robust set of consumer protection provisions. As a state licensed lender, we must ensure that we comply with both state regulations and 18 federal laws. This includes the Truth in Lending Act and the Fair Debt Collections Practices Act. We're routinely audited by the OSBC and by our federal regulator, the Consumer Financial Protection Bureau. House Bill 2189 would dramatically change the marketplace for small dollar loans in Kansas and make the lives of our non-prime customers even more difficult. HB 2189 would eliminate the payday loan product effectively and provide for small dollar loans under $2,500 only to the most credit-worthy of near-prime borrowers. A 36% interest rate with a $25 underwriting fee and a minimal monthly maintenance fee does not make the lending to non-prime consumers that we currently do viable today. The average FICO score for our customers is 575. Credit scores are impacted in many ways, and for our customers are not a true reflection of the customer's ability to repay. In addition to the information that is provided to us by the customer and their lending history with us, our proprietary underwriting model takes into account more than a dozen different pieces of data that we purchase from external subprime specialty bureaus to make a lending decision. I think one of the proponents for the bill talked about no underwriting for payday loans. We underwrite every loan that we make, including payday loans. Our operational costs, technology costs, underwriting costs, and cost of capital make lending non-prime consumers that we serve today not profitable under HB 2189. As a lender across several states, I can share with you a number of examples to demonstrate this point. I'll share just a few today that were mentioned earlier in testimonies. Pew Charitable Trust supported a bill in California with a 36% rate cap plus the federal funds rate and an origination fee of $75. On the bill effective date, we withdrew our existing unsecured installment product and our auto title product. 3 lenders that supported the California bill, OneMain, Opportune, and Lendmark, asserted that they would meet the needs of more than $1 billion in credit that was being provided by lenders such as us. TransUnion, one of the 3 main credit bureaus, just reported on their 2020 loan data for California. The headline of that TransUnion slide, which I have included with my written remarks, reads, "In California, new regulation cleared the installment market, pushing traffic to sovereign lenders and payday lenders." Sovereign lenders are not state regulated, and for California, payday loans are limited to $255, which is hardly a solution for non-prime consumers struggling to make ends meet. Pew Charitable Trust also mentioned that they supported the Virginia bill. On the effective date of the bill, which was just last month, we ceased to offer our line of credit product in Virginia because it was not viable to do so. I'm sure in a year's time, when credit availability in the market is measured, the results will be very similar to California. Illinois was also mentioned as well, too. We're waiting on the finalization of that rate cap bill in Illinois, and we have plans to shut down our store operations there. South Dakota and Nebraska, we were doing online lending, and when that 36% rate cap bill passed, we withdrew our product there as well. Mr. Bork from Pew Trust also mentioned that we operate in Ohio. In Ohio, we currently offer loans online. We're very limited in our product availability based on the current construct of the law. We only offer $300 over a 4-month term. Now that that bill has been in place for about a year, we are not profitable on that book of business, and we are making plans to withdraw that loan product from that territory. He also mentioned that we operate a couple of stores in Colorado. In Colorado, the statute is a little bit different than what's being proposed here today. We made the decision to keep our 3 stores open and are marginally profitable from year to year, if that, and we continue to evaluate whether it makes sense for us to continue to keep those stores open. Somebody also mentioned the 36% rate cap for under the Military Lending Act. We don't.
Ms. Soper, I just wanted to make sure you got about less than 30 seconds.
Okay, terrific. So traditional installment lenders like OneMain do lend in Kansas, but types and their customers are very different. For example, OneMain reports that their average unsecured loan is $8,000 on average over more than 4 years, and their average FICO is 635. Again, our average FICO score is 575. So very different loan products, very different customers. In Kansas today, there's a broad spectrum of lenders and credit options available, from a $500 payday loan to a bank loan or traditional credit union loan. At the lower end of the FICO scale, consumers access smaller loans with shorter durations that carry higher costs based on the difficulty of underwriting consumers with thin credit files.
Ms. Soper, if you could wrap up, please.
Yes, thank you. I wanted to make sure that I kind of addressed our other state operations that were mentioned in testimony. Thank you for your time today. Again, HB 2189 would eliminate a significant number of small dollar loan options and would dramatically change the landscape in Kansas.
Thank you very much for being with us today. And if you could stay around for questions at the end. Our next opponent is Brad Smoot, attorney at law on behalf of LoanMax. And we've got, it looks like, about a total of 11 minutes left for everybody. So welcome, Brad.
Mr. Chairman, members of the committee, can everyone hear me? Is it on? Okay, all right, thank you. Thanks, Mr. Chairman, members of the committee, I appreciate being here. I'm Brad Smoot. I represent LoanMax, which has been doing business in Kansas since 2004. And we are a lender, a title lender only. We don't do the payday loans that you've heard much about. But I want to tell you a little bit about our customers, about our history, and a little bit about the history of this issue in Kansas, if I might, and I'll try to stay within the time frame that has been laid out. LoanMax does business in 17 states, including, in addition to Puerto Rico. We maintain 26 offices in Kansas, employ 56 people, and we make tens of thousands of cash advances during the 16 years that we've been in business here. Suggesting, I think, that there's a substantial need for credit availability among our borrowers. These Kansans rely on LoanMax as a trusted short-term borrowing option. In fact, our customer satisfaction rate is exceptional. We've had no more than a dozen complaints per year over those entire 15 years, including complaints to all different sources, including the Better Business Bureau and so forth. All of those have been resolved, all without any fault being found on the part of LoanMax. Our customers come from a variety of backgrounds. From local business owners to hourly workers, our customers all have one thing in common, and that is that they need money quickly and easily. They may need a prescription filled. They may have suffered a recent theft or loss of their ID or their credit cards. They might have emergency vehicle repairs. They might have eviction and utility shutoff orders or frozen pipes, can you imagine that, that need to be repaired immediately. Life brings us all surprises and challenges that banks, savings and loans, good planning even, relatives, friends, and other sources of cash simply cannot and are not equipped to provide in an easy and prompt fashion. That's kind of where we come in. I've attached to my testimony a copy of some notices that we provide in order to keep that satisfaction that I mentioned as high as it is. We tell our customers, here's the sheet of paper I'm referring to, we tell our customers that this is a high interest loan. We let them know that they ought to check out other borrowing options. As you've heard repeatedly, there are plenty of other borrowing options, just those options are not available for everyone because of their financial circumstances or financial history. And we encourage them to pay it off as quickly as possible. Doesn't do them or us any good to drag these types of loans out any further than is necessary. We believe that House Bill 2189 would kill our industry, the title loan industry, the payday loan industry. I encourage you to read this entire bill. If you can make heads or tails out of it, you're doing better than I am. It's very, very confusing. But the bill caps interest rates, and that's the most important part. It will drive our company and others like us out of business, as it has done in other states that you've just heard about, denying our customers the credit access that they have today. Proposals like this are nothing new. We've seen them over many, many years. Oftentimes they're brought by people who believe that they're just doing good. And in fact, such efforts show little respect for the people who, and our population that we serve. It shows no respect for the intelligence of the borrowers or their struggles for obtaining credit elsewhere, or frankly, their wishes as adults. To many of our customers, this is downright insulting. And I say that only because you and your colleagues have heard that over the years. We've had hearings on this repeatedly in various committees. And it's not the lobbyists who come up here and change the minds. It's our customers who come up and change minds. Our customers come up and say, we want to be able to borrow in this fashion. We know the risks we're getting into. We know the rates. This is the way we need to solve our problems. And that's why we have a very high satisfaction rate and a very low repossession rates, about 5%, with all our loans. Our folks pay their loans off as quickly as they possibly can. The next point I want to try to address, if we still have time, is that if the folks that are promoting this bill really believe they want more competition and want to create more options for the public, including our customers, I don't think destroying some of those options, which is what 2189 would do, is a real solution. What we need are more choices, not less. I encourage the proponents of this bill to go put up their sign, get into business and compete with us. If you want to drive down rates, use competition. Don't come in and bring a law that throws one type of competitor out of the business so that you can come in with your unique products, which, by the way, are underwritten to the point that many of our customers couldn't qualify for those loans. There's probably a place for everybody in this marketplace. Let's give kudos to Bank of America that came in and tried to offer a loan product of $200 to its existing customers. It's not a big success. A new group of people can take advantage of it, but bully for them for trying. Likewise, our charitable organizations, Chuck was just here explaining that, they've tried over the years.
And we're at about a little less than 30 seconds.
Okay, I'll be as quick as I can. They've tried over the last couple of years to offer a product, and good for them for trying to do that. It's very small. They're doing it with basically free money because it's charitable dollars, but it's underwritten as well, and it doesn't satisfy the needs of many of the people that we deal with. Kansans still need quick, easy loans. If you outlaw these types of loans that would kill the industry in Kansas, you're not helping that group of people. This is an untested product in many ways, and the states that have been cited have just gotten into this business. I suggest that you study this as best you can so that you don't leave Kansas consumers without the options they need. Don't leave them with nothing to choose from. Don't leave them writing bad checks, not making their insurance payments or rent payments. Have some faith in their intelligence and their ability to handle their own affairs. Eliminating options is not good public policy. There's nothing in the law today that prevents our competitors and others from coming in and offering the products they want to offer and being able to compete with us, and we encourage them to do so. Mr. Chairman, I'll be available when you need me.
Thank you very much for being here today. And our final proponent is Whitney Dameron, PA, on behalf of the Kansas Community Financial Services Association. And Whitney, welcome.
Thank you, Mr. Chairman, members of the committee. I appreciate the opportunity. One of the benefits of going last today is most of the issues have been covered. Your staff did a wonderful job walking through both this legislation and the statutes in regard to payday lending. A couple of things I'd like to highlight. The industry is well regulated by the OSBC. The loan transaction is a straightforward transaction, which is why you don't have a great deal of consumer complaints. They know exactly what they're getting into. Back in 2005, when the law changed, the industry brought forward the military payday loan protection pieces in statute. It was not brought by OSBC or third parties. The industry brought that. We also brought down the maximum loan amount and made the transaction simply a more straightforward transaction for the consumer. Some of the issues that Mr. Smoot highlighted, there just is not this kind of a credit product available. We all can find any number of places if you have the right underwriting criteria or FICO score to buy a car, whether it's from a car dealer or a buy here, pay here lot or whatever. We can buy furniture from any number of retailers who will give you credit terms. What you don't have is someone who will loan you $250 to $500 if you have a pressing need, such as last week you go out, your car doesn't start because it's 10 below zero and you got to park your car outside, you got to get to work. Who are you going to call for $250 to get a new battery? Those kinds of lenders do not exist. We had a proponent of this bill that talked about their interest in coming into Kansas and making these kinds of loans. They have made those promises in other states. If you look at what they want to do is they want to take away all of these products So eliminate the loans for 100% of the people and come in and perhaps pick up 25% of the loans that are available, leaving the other 75% unserved. That's not a good business model from our perspective. Again, as Mr. Smoot talked about, it makes a lot more sense if this committee in the legislature wants to open up competition and provide these kinds of loans, opportunities in Kansas. Let's do that. But let's don't go in and wipe out something that obviously the consumers want, the consumers need, the consumers are using, because in many instances, that's all they want. I want to get through from here to next week. I want to fix the immediate problem that I have and take care of my family or whatever those needs are. A couple of things that I do end in my comments. Number one, we're going to see probably significant review of this entire area of UCCC lending from the Consumer Financial Protection Bureau with a new president, new administration. Also, if you put these loans out of business, go on the internet and Google payday loan. See how many tens of thousands of hits you get from both lenders that are licensed and a lot of them that aren't. Those lenders, if they're going to make an out-of-state loan and they're not regulated into a Kansas consumer, they're going to go in and get a hold of that bank account to put the money in, and that's a two-way street. And you're going to start getting calls that say, I had my account drained from some unscrupulous lender that came in here and had fees that I had no idea that I owed. And they're going to go to the OSBC and ask for relief, and they're going to say, we don't license those people. You drive people out of the market, they will find places to get their money. And the people asking to come in and be allowed to make the loans under 2189 won't make them to all the people of Kansas. Thank you, Mr. Chairman.
Thank you very much, and you did an excellent job there on time, and we've got our about 15 minutes available for questions, and we will now call the committee's attention. There are no written opponents to this bill, so your oral testimony is what we have for the opponent testimony. So this will officially close the opponent portion of our hearing on House Bill 2189, and we'll open it up for questions. And Representative Lynn, you're at the top of the list.
Thank you, Mr. Chair. My first question, I have a couple, but I'll just start with one anyway, is for Mike Ensbrenner from the OSBC. My question is, do you maintain the complaints that are dealing with the high APR, or well, with the APR rates, and given that they're illegal, do you still maintain a list of those complaints? And then in addition to that, do you believe that that stifles maybe the filing of loan complaints?
Yeah, we do have a list of all the complaints. What was the second part of your question? And I can get you all that information on any of those complaints.
Okay, I was just wondering if since it's legal, there are no problems. Well, legally the APR rates are still allowed. Does it stifle people filing complaints given that it's?
I don't know.
Thank you.
Mm-hmm.
Representative Hsu.
Thank you, Mr. Chair. This question is for the opponents of this bill. I understand the concern about, changing up the product mix in Kansas. I totally see that, but I also want to kind of examine, what purpose do these products serve? Are these helping the consumers, in a tight bind in a crisis? Do you guys know offhand, or can you get to me pretty soon, what percentage of customers are repeat borrowers? And of those repeat borrowers, what's the average number of loans they end up taking out?
Okay. Yes, Mr.
Chairman,
Smith.
that's a good question, but it's going to require some research. I'd be happy to do what I can to find out some information on that topic.
Thank you. That'll be good information to have. Representative Poskin, you have a question?
Yes, thank you, Mr. Chairman. My question is for Melissa Soper of Curio. I understand that she had similar concerns conveyed to Ohio lawmakers in 2020. And she said that they would stop lending in Ohio. Has that happened?
We haven't stopped lending just yet. We only offer a $300 loan for a 4-month term because that was the only loan amount in term construct that we thought may allow us to continue to only serve a percentage of our customers. But after about a year, we're finding that we are actually losing money on that loan book in Ohio, and we're going to be withdrawing that. So we're making plans to withdraw that loan product now.
Okay, thank you. That leads me to a follow-up question for Mr. Bork. He talked about best practices in Colorado, Ohio, and Virginia. And I'm wondering how lenders have managed to continue to operate in those states like Ohio, where they have to charge lower prices.
Mr. Bork, are you still on the line for a question?
I apologize. Can you hear me now?
Yes.
Thank you. Appendix 4 of our written testimony shows the types of loans that would be available under HB 2189. So for example, there are 3 different tracks that consumers in Kansas could follow. If somebody has okay or thin credit, they could get a consumer finance loan, and a $500 loan might cost them $65 with an APR of 43%. If they have damaged credit, but they have a bank account, like a payday loan borrower today, they could get a small installment loan under the alternative installment loan part of this bill. A $500 loan would cost them about $260 with an APR of 161%. Or if they had damaged credit and didn't have a bank account, they could get a secured vehicle title loan for a similar cost. This demonstrates, the ability to make $259 in revenue on a $500 loan, or $591 in revenue on a $1,000 loan, or $1,561 in revenue on a $2,500 loan under HB 2189. This demonstrates how lenders could easily stay in business if they chose to. And Appendix 1 of our testimony shows you that, in fact, those companies are continuing to make loans. So the way that they can do that is they change their model to make installment loans. They charge the allowable fees and follow the rules. They get licenses. Online lenders do it as well. And that's how they make loans available.
Thank you very much.
Thank you. And Representative Day, you have a question?
Thank you, Mr. Chairman. And I think this question is probably best for Brandon Mays, if you're available. So it seems that it's pretty clear from your testimony, from what you said here, that you believe the reforms within HB 2189 will work and allow a viable business model for companies within Kansas. But how can we be sure that we won't then force borrowers into worse scenarios under this bill? What's your take on that?
So obviously, our company started in Texas. Texas rates under installment lending as a whole are lower than what HB 2189 is allowing. We've successfully operated profitably under those statutes for the last 50 years. And it's, again, my lowest loan that I currently offer in my portfolio is $100. Highest in Texas is $1,400. I mean, I think the highest that HB 2189 is going to allow is going to be about $2,500. So at that point, it's going to open up the window for Kansans to borrow even more than the current payday statute and at affordable rates. And I guess to counter what the opponents have said, I mean, most of my consumers have an average credit score of average FICO score of about 600. So, I mean, I'm making these loans to subprime borrowers all day long.
Thank you so much. Thank you, Mr. Chairman.
Representative Hoheisel.
Thank you, Mr. Chair. I have a few questions here. My first one is for Brandon Mays. Brandon, you specified in your testimony that payday loan businesses are prohibited or prohibited from reporting to credit agencies. Is that a federal prohibition?
Not to my understanding, it's a prohibition by the major three. So Equifax, TransUnion, and Experian. They just don't allow their data to be reported to their databases.
Okay. Thank you for that. And my next question would be for Ms. Soper. Do you guys provide any kind of credit counseling to your customers?
We have different materials available on our speedycash.com website, but we don't do in-person credit counseling.
And do you guys upsell or, I guess, reward your employees for the amount of customers they're able to roll over into a new loan?
Well, first of all, on a single repayment payday loan, rollovers are not allowed. And a majority of our customers actually type the line of credit product because it provides them more flexibility. We do not have any incentives for our store level employees based on kind of number of loans.
And one final question to follow up on what Mr. Mays said. If the credit reporting bureaus allowed, would you guys have any problem reporting to those credit bureaus?
No problem at all.
Okay. Thank you, Mr. Chair.
I don't see any other ones. I have a couple questions other than Representative Poskin. Do you have another question? I see your hand is up. Nope. Okay. My first question is for Mr. Mays. You had indicated, I believe, that you do some screening and you report credit scores. What do you, if a customer does not pass the initial screening, what do you do? Refer them on to someplace, offer them options, or what? That if they are not able to qualify for a loan with your company?
Mr. Chairman, the vast majority of my loans, typically, again, you'd have to do something or be in a really bad place to not qualify, at least for my entry-level product. Meaning, you have verifiable income, you've been at a stable residence for 6 months. Our criteria, if you will, are very lenient. We're here to help the customer, not to hurt the customer. I'm in business, obviously, to make loans. If I don't make a loan, obviously, it's not profitable for me. But no, I don't have a referral source out to a lower grade product or anything like that. So if it's a decline for me, we follow the standard compliance for ECOA turn downs. Customer gets a notification letter informing them of why they were declined for the loan, so on and so forth. But I mean, as of lately, especially with COVID, I mean, we've actually lightened our underwriting at this stage to provide better access to credit for consumers than we ever have before.
Okay. Representative Wassinger.
Thank you, Mr. Chair. This is for Brandon. You want to start lending in Kansas. What stopped you before this, and how does this bill help you? Did I miss that answer?
No, ma'am. We are a traditional installment lender. So none of our products are payday type. So I don't offer single repayments. I don't offer balloon loans or anything like that. I fundamentally do not believe in them. When borrowers come to us, it's not that they need a stopgap between now and next payday. They need extra. They need something on top. They have an unforeseen need that has come up and they need something extra to help them meet that need. That's where my traditional installment loan comes in. And again, I mean, the feasibility for someone to repay, $1,000 in the next 30 days is just not feasible. And I would rather give them more time to pay that loan off as opposed to making it due in the next 30 days. Obviously, I can't offer installment loans in the state of Kansas under current legislation. That's the only thing that's prevented me from coming into the state and participating in the market.
Thank you, Mr. Chair. May I ask just one more question, not necessarily.
Okay.
Is there, and this is not just for you, Brandon, anyone who'd like to answer this, is there a compromise interest rate that would be a compromise that would be not as low as 36% for these higher risk loans?
I'm having trouble hearing the question.
Okay, sorry. Is there an interest rate that we could come to an agreement with that would not put payday loans out of business? Payday lenders, is there something in between the almost 400% and 36%? It seems like it's quite a change. Thank you.
Hey, may I address that, Mr. Chairman? This is Nick Bork.
Yes.
Thank you. I believe that HB 2189 represents that compromise because even though the interest rate is 36%, there are up to $30 a month in fees and other fees. And so the way that APR is calculated, it bundles together interest and fees. And so APRs under HB 2189 would extend all the way up to 196%. And that does sound high, but remember that it's much lower than what you see on Kansas payday loans today, which is 391%, and what you see on Kansas open-end credit loans today, which are often 299% and higher. So again, HB 2189 is designed in a way that would allow APRs that extend between 36% if the lender chooses not to add fees, all the way up to 196%, depending on the size and duration of the loan, if the lender does choose to add fees.
May I respond as well, Representative?
Go ahead.
Okay, thank you. APR is a function of the loan amount and the term, and the APRs under the current bill that is being proposed, only the lowest loan amounts for the shortest duration are going to see those APRs. We would be unable to have a viable business doing only that very, very limited kind of loan amount as we have seen in our Ohio business.
And,
Thank you, Mr.
Chair. Yes, Whitney.
Mr. Chairman, if I could just follow up again, Whitney Dameron, Kansas Community Financial Association. The challenge we've had with these kinds of bills that have come forward is they always start with, we're going to put you out of business and replace you with another product. And, in instances like today, you have a Washington, D.C. based think tank coming to Kansas telling the consumers what they need or should have, and taking away a product that is there that people are using through their own volition and working for them. So, from our perspective, we're more than willing to sit down and have a conversation about what gaps there are in lending in Kansas and how those gaps can be addressed. Right now, the maximum fee for a payday loan is $15 a hundred. There is nothing that says a company can't come in here and charge $10 a hundred, $5 a hundred. It's a maximum fee. So there's room for competition. We think there's room for discussion, but if your premise starts with you're going out of business first, and then we'll talk about what to replace it, that takes us away from the table. Thank you, Mr. Chairman.
Thank you very much. And we are just a couple minutes past our time, but I appreciate everyone today that participated, proponents, opponents, our regulators. I think we got some good information out. And then committee, this is going to be one that we will be working on over the interim to see if there are some ways that we can work out a equitable solution. And on Wednesday, stay tuned. We have our last meeting is on Wednesday, and have some things still up in the air for Wednesday. So watch your email, and we'll get the information out to you. But thanks for spending the time today. And again, thanks to everyone for being here, and our meeting is adjourned.